Good morning, everyone. Thank you very much for being here. I'm calling to order this hearing of the Senate Budget Committee entitled Risky Business: How Climate Change is Changing Insurance Markets. I will lead with my opening statement and then turn to my friend Senator Grassley for his opening statement, and then I will introduce the witnesses and we will proceed with their statements. Your full statements will be made a part of the record, so please keep to the allotted 5 minutes so we can get into a conversation. Ranking Member Grassley and colleagues, we are here today for the fourth committee hearing examining the budgetary perils associated with climate change. Today we focus on the danger to the National Flood Insurance Program and private insurers, and on the impact that climate-related natural disasters will have on insurance markets. As we've heard already in earlier hearings, and we'll hear again today, climate disruptions upset insurance markets, and that in turn upsets mortgage and housing markets. As we have heard and will hear again, sea level rise and wildfire risk can upset property markets so profoundly as to cause systemic economic damage across the whole economy, similar to what we lived through in 2008. You won't have to have property in flood zones or wildfire country to feel the pain. I hear colleagues say that the true long-term budget crisis affecting our country is debt and deficits. I'm happy to have that conversation. The President's budget would reduce deficits by almost $3 trillion, while adding at least 25 years of solvency to the Medicare Trust Fund. House Republicans want to add $3 trillion to the debt by extending the Trump tax cuts for the rich. Let's have that debate, but let's not pretend that economic shocks don't affect the budget. The 2008 mortgage meltdown added $5 trillion to the national debt, primarily due to decreased revenues. COVID added another $5 trillion. In both crises, we were warned, failed to act in time to head them off, and were engulfed. Today, those trillions of added shock debt amount to 40% of our total national debt. And let's not pretend that global climate disruption won't create economic shocks. Warnings abound of what rising seas, droughts, floods, and wildfires will do to American families and businesses and to our economy. This is the point. If you're serious about debt and deficits, you have to be serious about climate change. The Intergovernmental Panel on Climate Change, the scientists charged with synthesizing the latest science on climate change, a group cited favorably by previous Republican witnesses, released its latest report Monday, warning of severe risks to agriculture, infrastructure, public health, and coastal and flood-prone communities. The report states, climate change is a threat to human well-being and planetary health. There is a rapidly closing window of opportunity to secure a livable and sustainable future for all. The choices and actions implemented in this decade will have impacts now and for thousands of years. That's a pretty clear warning. Impacts for thousands of years. For our children's 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 children, and on into the future. I asked my colleagues, why are we here, if not to try and leave our nation and our planet better off for future generations? We have the chance now to bend the arc of history, of geophysical history, of economic history, of national security history, towards a more livable, prosperous future for generations. The economic report of the President also came out Monday. Just like we've heard in these hearings, it warns that climate change threatens volatile and cascading economic instability. Here's a relevant part. Certain financial instruments, such as insurance contracts and mortgages, I repeat, insurance contracts and mortgages, that directly or indirectly price weather-related risks are highly exposed to climate change. Rapid changes in asset prices or reassessments of the risks in response to a shifting climate could produce volatility and cascading instability in financial markets. I repeat again, volatility and cascading instability in financial markets. Property insurance against catastrophic natural hazards is at the forefront of climate change risk exposure and is already showing signs of strain. These latest reports echo statements made by the Treasury Secretary earlier this month. She declared, "Climate change will likely become a source of shocks to the financial system in the coming years. As climate change intensifies, natural disasters and warming temperatures can lead to declines in asset values that could cascade through the financial system. And a delayed and disorderly transition to a net zero economy can lead to shocks to the financial system as well." In response to rising insured losses, some insurers are raising rates or even pulling back from high-risk areas. This has potentially devastating consequences for homeowners and their property values. Developments like these can spill over to other parts of our interconnected financial system, end quote. I know there are powerful interests that don't want these hearings to happen, that want to change the subject, that want everyone to ignore the warnings from scientists, from economists, from financial institutions, from government. Those powerful polluter interests want us to listen instead to their noise and nonsense, the denial, the delay, the obstruction, the obfuscation that for far too long has halted a bipartisan defense against the climate threat. It's getting to be time to choose. What we do here now will not just have impacts for thousands of years, it will be remembered for thousands of years. We might do well to consider how we would like to be remembered, because that moment of choice is upon us. Senator Grassley.
Thank you very much, Mr. Chairman. The audience for today's hearing on private insurance is different than last week's hearing on the President's 2024 budget. As such, I would like to recap what we heard last week at our first and presumably only budget-centric hearing this Congress. What we received from President Biden was a budget that continues this country on a destructive path of deficits and debt. The budget doubles down on the reckless tax and spending binge of the administration's first 2 years. It calls for nearly $5 trillion in new taxes that will kill jobs and punish hardworking Americans. And despite all the lip service, it does not extend the tax relief provided to Americans making under $400,000 under the Tax Cuts and Jobs Act, so it increases taxes on just about everybody. This is a breach of the President's pledge not to raise taxes on the middle class. Not surprising for an administration that routinely breaks its promises as well as the law. We saw Democrats try to justify tax increases by pointing out that the last time we had a budget surplus, revenues were 19% of gross domestic product. Well, that means outlays were less at about 18%. Does the Democrat majority want that outcome? The administration surely doesn't, as spending in their budget will surpass 25% of the economy in the 10-year outlook. Outside of World War II and the pandemic, that would be the highest spending level on record. Last week, before this committee, the OMB director repeated the fallacy that the President's policies have led to deficit reduction. Now, only in Washington could you claim savings from not continuing temporary emergency COVID spending, and it would be laughable if it wasn't so disingenuous. We saw continued demagoguery from the administration on the issue of major trust fund programs. This administration has no plan whatsoever to shore up Social Security for future generations. Instead, they want to paint us Republicans as boogeymen for wanting to prevent automatic cuts that will surely occur, we know for sure, absent action by the President and the Congress. Where is the President's plan to protect seniors? because we know that Social Security is going to get down to no more than 77% of what it pays today by 2035. The Democrats have made their message loud and clear. They don't care about the fiscal problems facing us right now. Democrats don't have a plan to deal with inflation, even though their bills substantially increased inflation. And what I just said is, according to CBO, from Iowa to Rhode Island, our constituents collectively believe that our exploding national debt is a major problem facing America. The last two climate hearings held by the Budget Committee touched on the impact of sea level rise, hurricanes, and wildfires. We've heard from witnesses discussing costs due to these climate and weather events. We've heard the reasons we're seeing increased costs. Climate change is important, but it is not the only driver. Short of the need for better federal forest management, states, towns, and individuals can take care of most of their own challenges through smarter land use and development practices. While this committee is the Budget Committee, this hearing is not focused on the public federal budget. It targets the private insurance and reinsurance industries with speculative scenarios in an effort to raise alarm. My Democrat colleagues want you to believe that insurance and reinsurance companies are in dire straits due to climate change, and that insurance will become unavailable and unaffordable. I just read last week that insurance companies are leaving California for the simple reason that the government of California has to regulate every increase that goes into effect in insurance. And when the government's involved in that, you can't be in business in California. Well, that's not necessarily the case, and we'll hear from witnesses dispelling those extreme models. From hurricanes to wildfires, the insurance and reinsurance market have shown to be resilient. Rather than relying on federal intervention in the insurance markets or pushing more costs onto taxpayers, we should encourage more solutions from the private sector. I yield.
Thank you very much. Eric Anderson is the president of Aon and has spent more than 30 years in the insurance and reinsurance industry. We're delighted to have him here to hear his perspective. Nancy Watkins is a principal and actuary with Milliman. She too has spent decades in the insurance industry, and we're very pleased to welcome her and hear her perspective. Dr. Ben Keyes is a professor of real estate and finance at the Wharton School at the University of Pennsylvania. An economist by training, he has spent a lot of time studying the 2008 mortgage meltdown, and more recently has turned his attention to climate risk. We welcome his testimony. Jerry Theodoro is another insurance industry veteran. After a long career in the industry, he is currently the Director of Finance, Insurance, and Trade at the R Street Institute. We look forward to hearing from you. And Dr. Judith Curry, appearing remotely, is a professor emerita and the former chair of the School of Earth and Atmospheric Sciences at the Georgia Institute of Technology. She is currently the president of the Climate Forecast Applications Network. Mr. Anderson, if you would proceed.
Good morning. And as you said, my name is Eric Anderson, president of Aon, and on behalf of my 50,000 colleagues at Aon, I'd like to thank Chairman Whitehouse, Ranking Member Grassley, and each member of the committee for the opportunity to testify on the role that insurance can play in mitigating climate risk. Climate risk is a global systemic risk, and the insurance industry is a bridge between public risks and private capital. At its core, our business is about creating resiliency to protect the assets of today and foster the growth of tomorrow. We do this by spreading the impact of risk across a wide array of financial participants over time. This allows people and businesses to withstand volatility, to have the resources and confidence to invest, and to protect and rebuild when necessary. Properly managing climate risk not only protects against the downside, but can also be a catalyst for growth. Creating the tools to match capital to risk, to ensure the innovation necessary to reduce carbon, will create both climate transition and economic growth. The two forces, protection and innovation are required. Capital will not go where it is not protected, nor will it go where it cannot expect a return, even when communal benefit is clear. This is why public-private partnerships are so important. The committee has asked for an overview of global climate risk and the role of the insurance markets, and I'm pleased to provide that this morning. On January 25th of 2023, Aon published the 2023 Weather, Climate, and Catastrophe Industry Report, which I've included in my written testimony. The study has compiled data on recent extreme weather events and provides insight on our ability to rebuild from them. Claims data shows that 2022 was the most expensive year on record, with an approximately 50 to 55 billion of the global insured losses total result from Hurricane Ian in the U.S. That storm alone was the second costliest natural catastrophe in history from an insurance perspective, surpassed only by Hurricane Katrina in 2005, which was nearly 100 billion of insured losses. The report also highlights that over 31,000 people across the globe lost their lives in NatCat events in 2022. While the total number of fatalities remains below average for the 12th year in a row, the concentration of the impact has increased. Nearly 20,000 fatalities were heat-related deaths in Europe alone. As shown in our report, decisions in the insurance industry are driven by data, giving us unique capability to identify challenges and create innovative solutions across both the public and private sector. Through public-private partnerships with the government, Aon and others in our industry have helped stabilize Fannie and Freddie in the housing crisis, create an insurance market post-9/11, and every type of catastrophe in between. Making a market for risks that are vital to the economy but seem uninsurable is our most important duty. Just over a decade ago, in the wake of the financial crisis, the mortgage market was disappearing, undermining one of the pillars of the U.S. economy. Just as the U.S. economy was overexposed to mortgage risk in 2008, the economy today is overexposed to climate risk. But back then, the insurance industry, led by Aon, was able to help. We developed both analytical and insurance coverage products to transfer risks away from Fannie Mae and Freddie Mac to private reinsurance markets. 10 years on, this public-private partnership exceeds $40 billion in premium. The models and discipline allowed an orderly transition of the secondary mortgage market that exists today. We are designing similar risk transfer products to free up capital today for climate resilience efforts tomorrow. And I would highlight other private partnerships that we have undertaken. In 2021, the World Bank, Aon, and USAID teamed up to mitigate hurricane risk in Jamaica through catastrophe coverage. The bonds will deliver $185 million in immediate liquidity post-event, ensuring not only humanitarian relief in the case of a windstorm, but facilitating immediate economic investment pre-event based on the certainty of funds to assure infrastructure and property rebuild. Currently, we are pioneering the first employee resilience bond for a large employer in developing climate volatile country to procure a bond to provide cash assistance directly to employees in the event of a disaster to meet recovery needs. I also want to highlight examples of the industry forging a better path on its own by facilitating an energy transition and providing ways to bring new solutions to market quicker. For example, cat bonds were created to provide post-event coverage for traditional risks, but they also encourage pre-investment in research and development that could help clean energy transitions by ensuring certainty of funds to deal with the impact of traditional claims. In other cases, we are developing an industry-leading capability to enable a company to accurately value its intellectual property and then use it as an asset to finance growth. This allows them to bypass traditional funding and accelerate their time to market. For many green technology companies, this is becoming their best option. Climate risk poses substantial challenges to insureds and insurers alike. While insurance is based on the principle of diversifying risk, in many cases, insurance risk management becomes more challenging as events become more interconnected across lines of business, geographical regions, and perils. We are oriented around the philosophy that big problems need to be solved by collaborating. And that is exactly that. Humanitarian, private, and public sectors partnering together to prove that solutions can be found together. Thank you.
Thanks very much, Mr. Anderson. We'll just continue right across the table, so that would make you next, Ms. Wilkins. Thank you, Ms. Watkins. Thank you for being here.
Thank you, Chairman Whitehouse, Ranking Member Grassley, and members of the committee for inviting me here today. My name is Nancy Watkins, and I'm an actuary and principal with Milliman, an independent consulting firm. I serve as an expert on catastrophe risk for insurers, real estate industry groups, and state and federal government agencies. I also volunteer to promote insurance availability and affordability alongside the National Association of Insurance Commissioners, Western Fire Chiefs Associations, and the United Nations. Let's talk about homeowners insurance and how climate change is impacting it. First, climate change is not a problem of the distant future. It's already here. Across the country, we have insurance protection gaps and crises exacerbated by climate change. Flood risk in the U.S. is already very high, increasing rapidly, and unsustainable once you factor in sea level rise. NOAA reports that about 80% of the East and Gulf coasts are seeing more high tide flood days, and that this spring, about 44% of the U.S. is at risk for flooding. Most flood risk is not covered by the private market. Only 4% of U.S. homeowners have flood insurance today, largely through the government-run NFIP. Unprecedented wildfires have driven insurers to shed high-risk policies in western states like California, Oregon, and Colorado. In California, homeowners insurers lost $20 billion in 2017 and 2018 due to wildfire, wiping out 2 times the cumulative profits earned over the prior 26 years. Since 2020, Louisiana has been hit by multiple hurricanes, tropical storms, tornadoes, and excessive rainfall events. After 20 companies folded or exited the state, more than 100,000 policyholders are now in the state-run insurer of last resort. Insurance market withdrawals can cause ripple effects that endanger entire communities and create a downward spiral that's difficult to emerge from. This could happen gradually, but it's possible for weakened markets to collapse quickly through a crisis of confidence triggered by one event. Second, a broken insurance market is not the problem. It's a symptom of a larger problem, too much risk for the market to bear. The risks associated with climate change and catastrophes are owned by homeowners in the community, not the insurance industry. Much of that risk can potentially be transferred to insurers if there's a sustainable private market, which rests on 3 pillars: availability, affordability, and reliability. Climate change is interacting in new ways with other inherent risks, causing cracks in all 3 of those pillars. The policy actions intended to help can actually backfire and accelerate the collapse of the insurance market. This generally happens because these actions don't address the underlying problem, that the risk is too high. Often, this occurs when land use policies and building codes don't keep up with risk, resulting in a mismatch between actual versus perceived risk by homeowners. Because we aren't all actuaries, one way to effectively communicate the actual risk to consumers is to build the true cost of risk into insurance pricing. Risk-based pricing drives behavior. If you can buy low-cost insurance, or you aren't even required to insure your home against flooding, you expect this to be a safe place to live. If you can't get affordable insurance, you may act to mitigate the home's risk and reduce your premiums, or you may decide it's too risky to live there at all. The obvious downside is that premiums may be unaffordable for some homeowners. The government could decide that it's good policy to subsidize premiums, with the costs ultimately borne by others, generally current and future policyholders or taxpayers who live in lower risk areas, often in other states. To reduce premiums and the cost of subsidization, the only effective action we can take is to drive down the risk. Third, the cost of driving down climate risk is much lower than the cost of inaction. The choice to ignore climate change and manage from crisis to crisis puts more families in harm's way, with low-income communities likely to be hit the hardest and suffer the most. Failure to act early reduces the number of options available and drives up the cost of reaction at various government levels. To avoid this, we need to work collectively to bend down the risk curve. We need to have better data, better modeling, higher prioritization of mitigation versus disaster response, better stakeholder coordination, and resource assistance to those areas most in need. The sooner our society chooses to face the risks associated with climate change, the more options we will have to drive down those risks, and the lower the cost will be. Climate risks are complex and difficult to understand. The actuarial community is leveraging science and technology and working with other experts to measure these risks and communicate them to important stakeholders like this committee. We aim to give you the best information available so that you can make informed decisions. Thank you.
Thank you very much, and we turn now to Dr. Keyes.
Chairman Whitehouse, Ranking Member Grassley, and members of the committee, Thank you for inviting me to address how climate change is affecting insurance markets. My name is Ben Keyes, and I'm an economist and professor of real estate and finance at the University of Pennsylvania's Wharton School. My research agenda examines how households interact with the financial system and how the financial system manages risk. Today, I'd like to highlight how issues in property insurance markets affect household well-being. First, rising insurance costs are having a direct effect on households' pocketbooks. Across the country, average homeowners insurance premiums rose by 40% from 2010 to 2019. In addition, private insurers are exiting certain markets. The number of enrollees in state-backed insurer of last resort plans rose by 29% between 2018 and 2021. With rising climate-related risks and the rising cost of reinsurance, insurers will continue to increase premiums and exit markets, leaving homeowners with fewer choices, less protection, and more financial distress. Family budgeting is difficult as it is. With insurance premiums changing every year, it's nearly impossible for households to accurately forecast their expenses. For instance, this January, state-backed Louisiana Citizens increased their rates by 63%. Costs are also rising in the National Flood Insurance Program. In the first year of the Risk Rating 2.0 reform, 75% of premiums increased by the statutory limit of 18%. Half of all NFIP policyholders will see their premiums more than double after 5 years. Sadly, these increases will lead many households to choose to go without insurance. Rising insurance costs directly affect housing markets. Each additional dollar of premiums decreases the demand for a home, affecting the amount its owners can expect to receive when they sell. In more dire situations where homeowners cannot find insurance, lenders will not be willing to accept uninsured homes as collateral. These concerns are not merely theoretical. Economic research shows that higher flood insurance premiums lower home prices and make it harder to get a mortgage. My own research shows that the threat of future sea level rise lowers home prices today, as buyers don't want to be left with an uninsurable home down the road. In short, home prices have already started reacting to climate risk, even as we've realized only a fraction of the higher premiums and sea level rise expected in the coming decades. I want to briefly highlight why climate risks are so difficult to insure. After a massive fire in the city of Hamburg, Germany in 1842, local insurers failed. Reinsurance markets arose for fire insurance because fires are idiosyncratic events, allowing providers to create a diversified risk pool and spread these risks widely and effectively. Unlike the chances of a fire in a given city, however, climate risk is better described by the title of the latest Oscar winner. It's everything, everywhere, all at once. Climate change is simultaneously inducing heightened risk of flood, storm damage, chronic inundation, drought, excessive heat, and wildfires. These risks are inherently difficult to diversify. While reinsurance and the catastrophe bond market will continue to play a role in maintaining functioning insurance markets, there's no avoiding the fact that the increasing risk of large loss events will mean higher costs for consumers. The limitations of private insurance markets for insuring against these climate risks points to a larger role for the government. State and federal insurance entities will bear more of these risks going forward as private insurers pull back. If we do not take action on climate adaptation and mitigation, then we can expect private markets for wildfire and wind coverage to increasingly resemble the NFIP and rely on public support. Further costs will be borne by Fannie, Freddie, and the FHA, who make up 2/3 of our $13 trillion mortgage market, and by FEMA and other post-disaster aid sources. Topics surrounding insurance often feel remote or difficult to digest, but they impact everyday households. Far too many Americans are currently unprotected from climate risks. Only 1/3 of households in flood zones have flood insurance. And the First Street Foundation estimates that 6 million households are at significant flood risk but lie outside of FEMA's outdated floodplain maps, making them likely unaware of their danger. Private insurers aim to price their risks accurately, so we should pay close attention to the choices that they make. No matter your views on climate science, insurers are responding to the increased frequency of high-cost disasters and the latest scientific forecasts. The departure of insurers from property markets has serious implications for home values, the dominant store of wealth for the average household, and for communities that rely heavily on property taxes to provide basic services as well as defend against further climate-related change. Now's the time to identify policy solutions to reduce American families, businesses, and taxpayers' exposure to climate risk. Thank you again for the opportunity to testify.
Thank you very much, Dr. Keyes. Next, Mr. Theodoro.
Chairman Whitehouse, Ranking Member Grassley, esteemed members of the committee, Thank you for the opportunity to testify on how climate change is changing insurance markets. I am Jerry Theodorou. I'm the Director of the Finance, Insurance, and Trade Program at the R Street Institute, where, as earlier in my career, I conduct independent research on insurance markets and what drives their performance. Today's issue is important for insurance providers and buyers because climate change alters historical patterns of severe weather. It adds uncertainty to an industry whose role is to provide stability and protection from loss. There is broad consensus among insurers that the climate is changing in ways aggravating extreme events. My comments summarize more extensive written testimony and address three questions at the heart of today's hearings. What is the impact of climate on insurance markets? What is the financial condition of insurance markets? And how do insurance markets respond to climate change? Insurers are in the business of providing protection from severe weather events. When wind, fire, hail, and flood unleash their fury, causing billions of dollars in property damage, insurance is the economy's financial first responder, paying claims, getting customers back on their feet. Property insurance covers severe weather events, and insurers are capitalized sufficiently to meet those claims obligations. When such weather costs billions or tens of billions of dollars, insurers are cushioned with financial protection from reinsurance, the industry's shock absorber. Reinsurance enables insurers to limit their losses, maintain financial stability, while providing stability to customers. The insurance industry is highly competitive, with over 3,000 insurers, ranging from large national giants to small county mutuals. Reinsurance markets are also competitive, with hubs in continental Europe, at Lloyd's, in Bermuda, and in the US. And just as primary insurers limit their losses with reinsurers, reinsurance companies buy retrocessional cover to protect their balance sheets. So the broader insurance industry thus provides three protective layers: primary insurance, reinsurance, and retrocessional reinsurance, making insurance markets exceptionally durable. To illustrate, in 2010, in the wake of the Great Recession, there were 157 bank failures, but only 8 insurance company impairments. The low failure rate of insurers is due to their focus on capital management. Dedication to shepherding their capital has enabled the longevity of insurers and reinsurers. Many mutuals were founded in the early 1800s and are still going on strong today. The income statement of the insurance industry is solid. In only one of the past 5 years was there an underwriting loss, in 2022, from automobile repair cost inflation. And the insurance industry's balance sheet has strengthened in recent years. Its surplus, the extent to which assets exceed liabilities, rose from $750 billion in 2018 to over $1 trillion in 2021. And reinsurers also delivered healthy results through 2022. Insurance markets respond to climate change in two broad ways: by encouraging buyers to mitigate losses and with new products. Loss mitigation measures to improve resilience include discounts for hardening their structures and credits for communities that establish natural barriers, such as mangrove forests and marshes between bodies of water and buildings that are constructed. Other ways that insurers respond to climate change include named peril rather than all-risk policies, parametric covers, rebalancing of investments, attracting third-party capital, and offering private market alternatives to government programs. Ignoring climate change is not acceptable. Climate skeptics are not to be found in the fundamentally conservative insurance industry, whose job, after all, is to restore things to the way they were. We acknowledge those who call for waking up to the reality of climate change. Insurers have acknowledged it for many decades. Insurance markets have an appetite for climate risk, are in the business of dealing with it, and will continue to play a key role in absorbing and mitigating its risk to our economy. Thank you for the opportunity to testify, and I look forward to your questions.
Thank you very much. And our final witness remote is Professor Curry.
Good morning. I would like to thank the committee for this opportunity to present testimony. I'm Judith Curry, President of Climate Forecast Applications Network and Professor Emerita at Georgia Tech. My expertise is on climate dynamics, uncertainty, and risk science. Insurance markets are influenced by our perceptions of climate risk. Referring to climate change as a crisis is at odds with professional judgments of climate risk. The so-called climate crisis isn't what it used to be. In 2013, in the IPCC Fifth Assessment Report, the extreme emissions scenario, RCP 8.5, was regarded as a business as usual scenario, with expected warming of 4 to 5 degrees centigrade by 2100. Now, there is general acceptance that this extreme scenario is implausible. The value of baseline warming currently used by the UN Conference of Parties has been reduced by half to 2.5 degrees by 2100. This is an additional 1.3 degrees above current temperatures. It's difficult to overstate the importance of the shift in expectations for extreme weather events associated with rejection of this extreme scenario. Rejecting this extreme scenario has rendered obsolete much of the climate impacts literature and assessments of the past decade that have focused on this scenario. Landfalling hurricanes incur the greatest property and casualty losses among extreme weather events. Recent international assessment reports have low confidence that there have been detectable changes in the long-term record of hurricane activity beyond natural variability. The insurance industry's perception of a substantial future risk from increase in hurricane damage is enforced by 3 recent reports from the insurance sector. These reports infer misleadingly high damages by 2050 by using the implausible extreme emissions scenario. They also assume substantial increases in the number of major hurricanes, which is at odds with recent assessment reports. Further, these reports neglect the major modes of multi-decadal natural variability. These have had a dominant influence on the Atlantic hurricanes in the historical record. Implausibly high projections of U.S. landfalling hurricanes by 2050 result in inappropriate notions of insurability, inappropriate pricing of insurance, and misguided confidence levels of investors. Not only have we been misled about the amount of warming to expect and its impacts, we have also badly mischaracterized the nature of the risk from climate change. We have conflated the slow incremental risk from warming with the emergency risk associated with extreme weather events that have little to do with the warming. This mistaken conflation of risk is driving the stated urgency for emissions reductions and the rapid transition of our energy systems. A key element in insurance losses from extreme weather events is the reliability of the electric utilities system. Extended power outages contribute to loss of life. During extreme cold events, outages can result in substantial property damage from burst water pipes. This is what happened as a result of the extreme cold event in Texas last year. The worst winter problems are associated with continental scale high pressure systems, which produce very cold temperatures and weak winds over most of the U.S. Now, many coal and nuclear power plants have shut down. A lack of on-site fuel storage contributed to the Texas outage and the recent Christmas blackouts in areas served by the Tennessee Valley Authority. Near-term risks are associated with the rapid transition of electric utility systems to wind and solar. We can reduce the transition risk by reducing the urgency of the transition to be commensurate with the slow incremental risk from emissions-driven warming. This would allow time for evaluating and incorporating newer technologies that do not reduce electric power reliability. Climate change and its perceived threats provide an opportunity to broaden the relevance of the insurance sector to risk mitigation. Adaptation provides new opportunities to underwrite climate-exposed risks. Insurance companies can help prevent customers from incurring damage. They can also work with the public sector to improve building standards and land use policies. Climate variability and change with the attendant extreme weather events is best regarded as an ongoing predicament. This will require continued adaptation by communities and businesses, plus mechanisms to share and transfer financial risk. Thank you.
Thank you, Ms. Curry. If I might, Mr. Anderson, ask you for a more practical and commonplace definition of the phrase you use, global systemic risk. We've heard a considerable number of our witnesses talk about systemic risk. It has a rather bland quality to it, but it describes something that is anything but bland. What would be your description of systemic risk?
So what we mean by systemic risk is the interconnectedness of these types of risks. And a number of the other panelists also mentioned that ultimately one event has implications on supply chains, physical damage, displacement of people. And so history, as people have looked at those risks over time, they've often looked at them very separately. But with climate change, the effect that it is having on the size of the storms, the wildfires, the effects of it, are actually creating risks that are so interconnected, they have to be dealt with in totality as opposed to just by individual factor.
The way that I have described this is that climate change causes weather anomalies, and those anomalies make events harder to predict. And that added difficulty of prediction compromises insurability. And as insurers either withdraw or raise prices, that has an effect in mortgage and property markets because it's very hard to buy a mortgage property if you can't insure it. And of course, without mortgages, demand for properties collapses because you're only selling to all cash buyers at that point. And when demand collapses, values collapse, and that can cause severe economic harm across the entire economic landscape. Is that a fairly accurate description of how this cascades through to from weather discrepancies to a general property values problem?
I think your underlying hypothesis that the models of old that have been used looking backwards are not as valuable to the models that need to be developed for a changing climate. So that is the underlying premise. If you're looking to match risk and capital together, the inherent sort of assumption in that is confidence that the risk that's being transferred is predicted and therefore can be priced appropriately for the risk that's assumed.
You can't insure what you can't predict.
You can't insure what you can, because the capital will not be protected. And so
you made a comparison in your testimony between climate risk today and mortgage risk in 2008. Why did you make that comparison?
It was designed to be an example of where using the information that Freddie and Fannie had on mortgage default risk, the ability of the insurance and reinsurance industry to bring modeling capability to do the predictability, actually to understand that risk, and then bring new sources of capital into the market. That's essentially what we're talking about with climate. Ultimately, the size of the capital pools that need to be brought to bear to help manage and transfer these risks to a broader financial sort of pool of capital is ultimately our strategy in helping clients deal with this issue.
And to perhaps state the obvious, as the president of Aon Corporation, you have a fiduciary duty to your shareholders and to your employees and to your customers to try to get this right. And that requires that you pursue and obtain reliable forecasting, not just for the business reasons of making money, but also for the fiduciary reasons of not misleading anyone. Is that a fair description of the accountability that you operate under?
We take a very strong position that our opportunity to help our clients manage this risk, and when you talk about it as a client, it's not just a corporation, it's a community, it's people that live and work in that community. Our efforts around understanding and trying to predict the effects of climate change and then developing products and solutions that actually allow people to transfer that risk as best they can so that they have the funding available to either rebuild or support those displaced individuals, we view as one of our most important roles going forward.
And you can't just say what you please. You're bounded by the fiduciary duty to be truthful and accurate and operate on the best information you can find.
Of course.
Ms. Watkins, in your testimony, you talk about the ripple effects of insurance withdrawals, which I think I tried to explain in my questioning to Mr. Anderson, that can endanger entire communities and create a downward spiral that's difficult to emerge from, and in which collapse can happen quickly, often through a crisis of confidence triggered by one event. Could you elaborate a little bit on that scenario and how that plays into the problem of systemic risk and economic harm?
Yes, sir, and I do agree with your description, and I would extend it a little farther to when real estate values start dropping. Also, this is accompanied by quality of life issues. In my current home state of California, we're having power outages, smoke that can make it hard to go outside all summer long, a day where we never saw the sun because of smoke. Those sorts of things, the need to evacuate frequently, which happens a lot of times in hurricane-prone areas, that kind of uncertainty can combine together to cause people to want to leave. At that point, you have a disincentive for businesses to, establish new roots in a community. You have a reduction of the tax base. Concurrently, real estate investors and municipal bond investors are also that they're looking at climate change and making their long-term decisions, and so the influx of investment into a community that's not resilient to climate can be reduced as they're competing with communities in other areas for that kind of investment. So the tax base goes down, the cost of borrowing can go up. It can be harder and harder for a community to try to deal with the risk as even if it stayed the same. But if it's increasing, they just get squeezed. So that's what I'm talking about in terms of the downward spiral. The crisis of confidence, I think in a non-insurance example in the recent news, we have Silicon Valley Bank, the kind of last man at the bar syndrome, where the people involved in the risk who felt like they were at risk decided they were going to pull out. And that pullout could actually not only endangered that bank, but other banks that others thought were in similar situations, whether or not they had actually made the same kinds of decisions that led to Silicon Valley Bank's with collapse. So what we have, just for example, California, we have the California Fair Plan, which is growing unsustainably high. As the insurance market withdraws, the Fair Plan increases. It's supposed to be a crutch for the market. It's supposed to prop up the market while the market heals itself. But the problem is when policy makers decide to turn the crutch into a leg and start paying attention to protecting the crutch and making it more of a long-term solution, it's no longer an effective crutch, and it's not a very good leg either. So we're not healing the broken system in the process. Right now in California, the Fair Plan is running at a $332 million deficit. That was about a year and a half ago. Their rates are 72% inadequate at last report. They're only reinsured for a 1 in 31 year return period at last report. If the Fair Plan, whose total insured value has gone up by over 4 times in 5 years, were to have a multi-billion-dollar loss, which is very possible, there's an unlimited assessment on the California insurers who stay in the market. So every insurer who wants to stay in California, maybe they've pulled out of high-risk areas, but they're insuring low-risk areas, they are on the hook for the Fair Plan's potential insolvency in case of a large event. So
I've got to stop you there since other senators are asking to wait their questions, but ask their questions. But thank you very much. Sure. And Senator Johnson is next.
Hey, Mr. Chairman. Dr. Curry, let me start with this statement that I'm not a climate change denier. I'm just not a climate change alarmist. I get a feeling from listening to your testimony, maybe you're a little bit more on that scale with me than more of an alarmist. But I thought it was interesting in your testimony, you talked about when you look at the real history of occurrences of hurricanes, I've certainly looked at the history of wildfires, that there's really nothing out of the ordinary in terms of long-term perspective on this. Can you expand a little bit more on what you were talking about? You were just referring to that in general. Can you get a little more specific?
Sure. Looking back in the historical record of extreme events, that in the first half of the 20th century, particularly the 1930s, the weather and climate extremes were much worse than anything we've seen so far in the 21st century, in terms of the worst landfalling hurricane, the worst heat waves, the worst droughts, the worst fires, and on it goes. And if you look at the paleoclimate record, you can extend even further back, and you see evidence of even greater extremes. The worst atmospheric river event in recorded history occurred in the 1861 to 1862 winter in California. I mean, we think it's bad this year, but it was much worse back in the 19th century. And even worse events that you can see in the paleoclimate records. So we need to temper our perception of what's actually going on right now with the extreme events.
So I appreciate that. And, we mentioned, earlier witness talked about Silicon Valley Bank and what's happening there. What you have is a lack of confidence. And so if we have all these hair on fire predictions, it's going to reduce confidence, and it's going to be a self-fulfilling prophecy. So let's talk about the reality. You just talked a little bit about the reality of extreme events not being out of the ordinary. Mr. Theodoro, from my side, again, I don't deny the loss in property, but isn't that more related to the fact that we are building incredibly expensive properties in highly vulnerable areas, whether it's in mudslide areas in California or wildfire areas where we're not doing proper forest management to prevent wildfires? What we're building on the Gulf Coast and the Atlantic shoreline, unbelievably expensive properties. So when a hurricane does occur, yeah, there's going to be a lot of property damage. So isn't the real issue here properly pricing the insurance and, quite honestly, making the owners pay for the risk that they're taking? And we don't do that. We subsidize that risk, and so there's more risk taking. Can you just kind of speak to that?
Yes, thank you, Senator Johnson, for the question. And it's both. And indeed, there are more values now that are at risk. There is more unsound development on coastal areas and on floodplains. There's more impervious surfaces, as you have asphalt instead of dirt to absorb the water. So you have higher values, and that's the driver of the higher losses. But also, there are more of these extreme events. The 1861-1862 arc storm in California that led to Governor-elect Leland Stanford going to his inauguration in a rowboat in Sacramento was considered a 1-in-1,000-year event. That's why it was called an arc storm, A-R-K, atmospheric river K for 1,000. Research has shown that it was actually happening every 200 years. But more recent research from NOAA is now saying that this can happen every 40 or 50 years. So there are more of these extreme events. And as you said...
Okay, that's contrary to what Dr. Curry is talking about, but go on. By the way, do you have, the insurance industry, have you calculated the property value in these vulnerable areas today versus, let's say, 50 years ago? I mean, do you have a sense of how much more property is at risk? Whether or not we have more extreme events, I mean, when an event occurs, we're going to have a lot more property damage.
Yeah, the industry does tabulate this, and there are modelers that look at that. But indeed, the values have gone up because of population growth and building which is not sound. It's on coastal areas and on floodplains, not built to code. So that's an important factor, and we should discourage this sort of bad behavior and have protections, mitigation. But the evidence, the facts are looking at the events and the severity of the events that have been more frequency of severity.
So my point is that's something we can do something about, not building in vulnerable areas. We can
Yes.
do something about building to code. I don't think we can hold back the tides. So why don't we address what we can actually do versus scare the you-know-what out of everybody, reduce confidence. That doesn't help either. So thank you, Mr. Theodoro.
Indeed, thank you.
Senator Van Hollen, and then the distinguished ranking member.
Thank you, Mr. Chairman. Thank you all to all our witnesses. I think the goal here is to really understand the risk. It's not to scare anybody, but it's to make sure people understand the reality that when you have a climate crisis and you have more extreme weather events and you have increase in sea level rise, we have to understand what its impact is and plan ahead so that we can avoid a crisis when it comes to the financial piece. We obviously have to address the climate piece, and the chairman and I and others have been working on that, but we do need to understand what's happening here. So, Dr. Keyes, in recent weeks, we have seen a number of very high-profile bank failures. I understand fully that the insurance markets are regulated differently, but they still need to be adequately capitalized. So do you perceive a risk today with respect to insurance companies being prepared as a matter of capital to deal with the ongoing risks from climate change?
Well, thank you for the question, Senator. I think others on the panel may have more expertise on this than I do, given that they manage a balance sheet more directly. But I think this is an absolute cause for concern. And when we look at the failures of insurers in Florida and decisions to pull out of Florida in particular, I think that speaks to some of these concerns directly, and that there are worries that they don't have the balance sheets directly and that they can't obtain sufficient reinsurance to protect themselves, that they're leaving risky markets. And so one of the explanations for the shift in their choice of which markets to insure and which to not insure is in part a function of their balance sheet.
Well, let me pose the same question to Mr. Anderson, and picking up on what Dr. Keyes just said, right? There are two ways that insurance companies could respond if they wanted to address the risk. One is to increase rates, and that's true also in the reinsurance market, and that obviously increases rates for consumers. Or they can decide just to pull out of insurance markets in certain areas, like parts of Florida. Can you talk about what we're seeing right now and its impact on consumers?
Sure. I mean, the crisis of confidence that's happening in the reinsurance market that's leading into the insurance market is essentially a crisis of confidence around the ability to predict loss, which is kind of your question around, is climate changing the confidence level that these insurers and reinsurers have around providing products to consumers or businesses? And the short answer is the reinsurers today have been withdrawing from high-risk areas around wildfire, around flood in particular. Some of the other natural catastrophes like earthquake, less susceptible to this topic, and so not as much dynamic change. And so the question of, is there enough capital to handle the transition today? The answer is no. The effect of how do you create more capital is better transparency around predicted losses. That's where a lot of the work in the industry is going today, because private capital will not join the market unless they expect a return, and they will not be able to expect a return if they don't know the risk they're taking. And so the answer to that is they essentially trim their offerings. They pull out of high-risk areas. They drop certain products. They get out of certain states. This is happening, by the way, around the world. It's not just a U.S. issue. But the underlying facts of the decision-making are the same, which is they don't understand the risk they're taking, and therefore they won't take them.
Right, and Ms. Watkins, just to follow up on this conversation, it seems that there are actually three possibilities here. One is that we don't do enough in advance, and you have a meltdown in the ability of insurance companies to make coverage, or you increase price And obviously, that means consumers are paying more. Or insurance companies pull out entirely, as we're seeing in Florida and other places. Or when insurance companies pull out entirely, it's the taxpayer that ends up picking up the bill. Isn't that right?
That's exactly right, Senator.
I mean, those are the options. Can you talk a little bit about what's going to happen to homeowners in coastal communities? It seems to me there are really just two options for folks who are don't have any more coverage. One is that they're on their own and they have huge risks, and their nest egg, it just goes under, or the public sector provides a bailout. Are those the two options there?
As of right now, yes, sir, I do believe those are the options. And so, I mean, we do have federal disaster aid, which will come in and if there is like an event that creates a loss and they have no insurance, that would help them somewhat, but it won't really restore them to a resilient position for the home. I think that to get in front of that and to try to give people better information when they're making the decision to live in a place, having the insurance risk signal would help avert both of the situations that you mentioned.
Thank you. Well, we see what happens when people don't get in front of a banking situation. The same would hold true when it comes to the insurance market. Thank you, Mr. Chairman.
Thank you, Senator. Senator Grassley.
Yeah, I'd like to go to Mr. Theodoro and follow up a little bit where Senator Van Hollen's subject was brought up. You spent 30 years as a leader in the insurance industry. However, you're now an outside analyst with no financial ties to the industry, I understand. Could you explain how the insurance industry is designed to withstand hits and manage risk and has done so consistently? Should we be worried that the sky is falling on top of the insurance and reinsurance industries because of climate change?
Thank you, Senator Grassley, for the question, which is actually two questions. Is the insurance industry designed to take big hits, and should we be worried that the sky is falling? If I can address the second one first, is if we put it in context, the stresses on the insurance industry, historical context, there have been crises and problems that the insurance industry has faced before. Just go back to the pandemic a few years ago. Early in the pandemic, there were voices saying that workers' compensation losses would be so great because of essential workers contracting the virus, going to emergency rooms and dying, that it would be too big a loss on the insurance companies for workers' compensation. That did not happen. Workers' compensation insurance did quite well, and rates have come down in most states. Dial back a few more years to the subprime mortgage crisis. There were so many bank failures, but the insurance industry did not have more than its long-term average of failures. So it withstood that crisis as well, which was systemic as it affected many aspects of the economy. Go back another 10 years. Lloyd's of London. Lloyd's had its crisis in the 1990s when asbestos risk from U.S. asbestos liability almost brought Lloyd's to its knees. But it went to work with reconstruction and renewal, reformation. They fixed their underwriting practices, and now Lloyd's is a strong player. 10 years before that, in the 1980s, the great liability crisis, when lawsuits were going up for medical malpractice, products liability, and there was voices there saying that this is going to destroy the industry, but it did not. So it's withstood many crises before. It's a durable industry. We look at companies that have been around for 200 years. Chairman Whitehouse, Providence Mutual, founded in 1800. So it's been around for 223 years. Vermont Mutual, early 1800s. We mentioned Cologne Re, 1846, which is now part of Berkshire Hathaway. To be in business for 200 years and to face these kinds of crises, you've got to be doing something right for your customers.
Okay. I want to go now to Dr. Curry. Many risk assessment firms use extreme hypothetical data when evaluating climate risk for commerce. We've heard several, especially wild figures today. Can you explain how the data from these models are transformed into these alarming statistics, and what incentives do companies have in using these apparently flawed metrics, and how does it affect the public?
Okay, thank you. Well, it's a challenge to keep up with all the latest scientific publications. Extreme projections of climate risk from risk assessment firms are largely driven by focusing on the extreme and implausible emissions scenario, RCP 8.5. These firms may be unaware that RCP 8.5 is now regarded as implausible. Mr. Theodoro mentioned a recent publication that predicted an increase in frequency of extreme atmospheric river events to every 40 years. However, the climate model simulations used in this paper was driven by the extreme implausible emissions scenario, RCP 8.5. So continued use of this extreme implausible emissions scenario is misleading both the public and investors about what kind of extreme events we might expect in the coming decades.
Dr. Curry, how have sensationalized emission scenarios come to dominate the discourse of climate change risk, and why has it taken so long to realize that these scenarios are implausible?
Okay, the extreme RCP 8.5 scenario was originally formulated to provide an upper limit to possible climate outcomes. RCP 8.5 has been misleadingly referred to as a business as usual scenario, which it is not. Climate scientists find that the extreme scenario helps understand how the climate system might respond to a big poke. Scientists working on climate impacts prefer the extreme scenario since it gives the most dramatic results. Such research receives a lot of media attention and supports a political agenda of urgently reducing emissions. For the most recent IPCC assessment, a more advanced approach to developing scenarios was used. These new scenarios were derived from socioeconomic and technological trajectories that the world might follow in the 21st century. However, energy economists found it extremely difficult to develop trajectories to achieve the 8.5 forcing without making implausible assumptions such as increasing coal use by 600%. But by this time, the IPCC had already issued its assignments to the climate modeling community with a continued focus on the extreme 8.5 scenario.
Thanks very much. Senator Padilla.
Thank you, Mr. Chairman. Was glad to participate in our recent hearing on wildfires to highlight the importance of investing in climate and disaster mitigation, especially since the costs pale in comparison to the costs of inaction. That's why today we must also consider the importance of these preventative efforts. This includes the California Wildfire Mitigation Program, which is a state-level partnership with FEMA to provide grants for home hardening and other proactive measures. Not only do these actions protect homes and save lives, but they also provide confidence to insurers, which can help bring down costs for families. However, many of these programs require a federal cost share, which can be difficult for low-income and tribal communities to afford. And we simply cannot afford to further compound the issue by only protecting those who can afford it. My first question is for Ms. Watkins. Could you discuss the importance of ensuring that the communities of greatest need, greatest vulnerability often, are able to access these preventative resources, and maybe discuss briefly whether we should consider modifying insurance premiums for families who need that flexibility?
So just to clarify, you're asking me how to get communities of greatest need access to federal grants?
Yeah, how do we address the accessibility vis-a-vis affordability concern?
Thank you for asking. Yes, I believe that the best way to help the communities, the lower-income communities especially, is to give them information first, a realistic information of what they can expect, and then assist them. And that really starts with the best view of risk possible, and then an understanding of what are the most effective ways to drive down the risk. Wildfire is really complicated because it often starts in a place that's outside the community, so it's not under the control. PG&E, of course, has been associated with many of the ignitions. There's lightning, but it can start in other lands and then burn into a community. So in my work with the Western Fire Chiefs Association, what I've been told is that our coordination between the Forest Service and then inside the communities and the insurance industry and the different areas responsible for fire management is not where it should be. So what I believe they're saying is that we should prioritize WUI community fuel mitigation and then have more resources devoted to the communities that need the most resources.
Okay. Let me, just because our time flies around here,
Sure.
Jump to a second question and follow up with you on the affordability concern. Because I think there ought to be some flexibility to recognize the ability to pay in some communities and among some households. But you touch on where there's a dynamic of where fires start, there's a dynamic of where fires impact as they grow. I won't rattle off all the statistics of the series of wildfires California's experienced this last decade, worst on record. Nearly 13% of land area in California has burned, et cetera. But needless to say, every community has some level of fire risk. I want to ask, and I'll invite all of you to jump in here, what the crisis that we've seen, wildfires in the West, have meant for access to insurance policies in the West, particularly for rural communities or the communities in this, wildland-urban interface areas.
Thank you, Senator Padilla, for the question. Other states have made available grants for strengthening, for hardening homes, for having the roofs attached so that there wouldn't be embers going through the ventilation. Alabama initiated a program about 10 years ago, which was copied recently by Louisiana. And in my written testimony on the record, we do discuss California and Florida that are offering incentives in the form of premium discounts. And to the affordability question, well, first, the prudence or the imprudence of building in areas where you have the urban-wild interface needs to be addressed. You need to have the standards, such as the IBHS, the Insurance Institute for Building and Home Safety, Business and Home Safety, that has the specifications, what are the codes to limit wildfire. And as for the affordability, as with other programs, means testing should be available for those that are indigent or otherwise can't afford the insurance or the cost of doing the hardening.
If you want to go ahead, Senator, you can take another minute. Oh, I'm sorry, Senator Braun is here.
And insurance providers better at modeling future wildfire risk and identifying mitigation tools and other potential solutions. Thank you, Mr. Chair.
Thank you very much, Senator Padilla. Senator Braun.
Thank you, Mr. Chairman. This is a complicated discussion in the sense that there's so much variability in terms of what the future does look like. It looks like the science is starting to zero in on some particularity. In the actuarial business that you're in, it seems like it would be probably one of the hardest topics to get in some type of way that you feel comfortable with what the future looks like. I think I'm a Republican that believes that we need to be in the discussion. I mostly interface with farmers because I've been involved in agriculture, and they think something's afoot. I think that if it's as bad as it may be forecast to be, and I'd love to hear your opinion on it, because that's where premiums and risk management are all going to have to come in. And I think you're at the forefront of how we finally crystallize, what this discussion is about in general. So I'd like anyone that wants to weigh in on it. Have you actuarially gotten your hands around what this is going to look like? And should this be something that we're trying to prevent in terms of mitigation ahead of the calamity? Or are you going to kind of just take each year of further information to do a better job at kind of making sure that the financial risks are covered with fair premiums based upon the magnitude of the underlying risk? That sounds like a complicated formula to come up with. And like your honest opinion, if you think that you'd be having huge risks that you couldn't really cover adequately, and that maybe some of the solution would be to mitigate ahead of the problem, since it especially looks like the world's maybe not buying in collectively to do the things that might even be prescriptive. When I look at the CO2 that's being put into the air by other parts of the world, there are only a few countries headed in a place where it might make sense if, in fact, the science looks like that's where we're actually headed. It's kind of a sprawling question, but I think it hits the heart of the matter.
So maybe I'll bravely jump into the first part of that. And the one thing that struck me that I wanted to add to your question is the timing is a real issue for us, for the insurance industry, in that these are decisions that get made and money that changes hands. So there is an immediacy to understanding the current risk that a risk taker is assuming. And so when people talk of climate change, they will talk of the effects of climate change today and what does the industry have to do and how do they better understand the impacts today on farms or businesses or consumers. And then what is the impact over 20, 30, 40 years, which gets harder to assess if you are in our seat.
Well, in the short run, say short run where the rubber meets the road, are premiums covering the amount of risk out there and being able to pay the claims in a sustainable way?
So the short answer is no.
And how long has that been the case?
I would say over the last 4 to 5 years, based on the losses that have come through the industry, the confidence of the capital providers that they have a full understanding of the risk that they're taking has been weakening over time. And so this year in particular was a pretty dramatic repricing of risk that happened in the reinsurance industry that is now coming through to the insurers and then ultimately to the consumers. They don't trust the models. They don't quite understand what the impacts are going to be. And since these contracts happen today and they deal with issues of today, their focus is today and what are the impacts financially. But ultimately, they do recognize that they need a truer sense of risk and the changing nature of it in order to attract the capital that they need to provide.
And are you spreading that risk over a broader segment than just the places that seem to have the highest claims?
Absolutely. I mean, the whole nature of the business is to diversify it across various financial pools of capital over time as well. So not just location, but time.
So everybody will pay the price, even for something that might be localized or regional.
Yes.
Anybody else want to weigh in?
Senator Brown, to the first part about the difficulties in pinpointing what will be the amount of the losses and when, it is difficult indeed because actuarial science is mainly backward-looking. Now we're talking about a moving target because the exposure level is changing. And yes, there are models, as Mr. Anderson mentioned, but it's said that all models are wrong, but some are useful. So we know that directionally it is getting worse, but we do have to do something. And to your point on mitigation and resilience, that's really where the industry is going. Because once you do have better behavior, you don't have building on the coasts and in the floodplains, that will send a signal, a price signal, when there are losses and the rates go up, for people not to build in ways that exacerbate the risk. So you have the positive incentive from price signals.
Mr. Chairman, could I have one more brief question? So, in the extrapolation of what has been extra normal, it sounds like, over the last 4 to 5 years, and compared to the past when you just have weather incidents that were more sporadic, is the insurance industry now extrapolating based upon a new model that's based on what has had some consistency over at least the last 4 or 5 years, or are you still waiting to do that to where you'd fully price the risk into your premiums?
The models are recalibrated on a regular basis. So the industry is not sitting on outdated models that don't take into account what's happening in California and in other parts of the country. So they're trying to keep up, but it's like hitting a moving target because the denominator is changing.
And in the area of the highest claims, will this be priced into those localities in a way that would cause the mitigation of maybe not living where whatever the climate impact is that's having the greatest effect?
It is, because you have many of the national insurance companies have separate companies that are focused on a particular state.
Okay.
It's just Florida, for example, which is problematic not so much because of catastrophes, but because of litigation, which has gone out of control, with 86% of the nation's homeowners insurance litigation, although Florida only has about 7% of the nation's homes. So that's a separate issue there.
I was just going to very briefly add that I think, and thank you for the question, I think one of the nuances here is that insurance policies are written on an annual basis. We have mortgages that are written on a 30-year basis, and we have homeownership decisions which are written maybe on a lifetime basis, or even longer, passing on a home in a generational way. And so we see the insurance markets responding very rapidly because they're repricing.
You're the true variable cost in the equation.
Exactly. And so they're going to be the ones who are most flexible in a lot of ways. And that means that these other markets should be taking a lot of signals from what the insurance markets are doing.
Ms. Watkins, did you have?
You had asked about modeling, and the insurance industry is definitely recalibrating their models, as Mr. Theodore said. They are also building a track forward into the future, looking at different climate scenarios. And so they are becoming able to predict this out in the future, but that hasn't historically been a focus. These models are also being used by long-term investors, and Fannie Mae just had an article where they're looking at these models as well. But to your main point, mitigating ahead of the calamity, I think that was my focus, is finding the money and aligning the stars to start reducing the risk, which isn't traditionally in the purview of others.
Thank you. I think your industry is going to be on that leading edge of what actually takes an amorphous conversation into something with a few particularities that we can look to guide us in the future. Thank you.
We'd like to be.
Thank you, Senator Braun. I will do a second round, and I guess I'd like to first start by asking the witnesses who are here present in the room whether any of you endorse the proposition that there is nothing going on here that is out of the ordinary for climate-related risk. No, 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 no? Okay. Do any of you doubt that unusual risk is being caused by emissions from fossil fuel combustion? No, 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 no. Everybody accepts that correlation exists. Okay. Thanks. Ms. Curry, I've got a few questions for you, if you don't mind. First, do you recall how many times you've testified before Congress on the subject of climate change?
I'm sorry, I didn't hear the first part of the question.
Do you recall how many times you've testified before Congress on the subject of climate change?
This would be my 13th time.
Thank you. And on those occasions, has your message essentially been that there's a lot of uncertainty, we don't really know what's driving observed warming, the models are unreliable and the IPCC models are not to be trusted?
No, that's not what I would summarize my statements as.
All
There's,
right. Well, let's revisit one of the previous times that you testified before Congress in 2014 before the Senate Environment and Public Works Committee. And I was your interlocutor then. I don't know if you recall that among your 13 episodes of testimony. But let me prompt you. In your written testimony for that hearing, you wrote that several key elements of the IPCC's fifth assessment report point to, your language here, a weakening of the case for attributing most of the warming to human influences relative to the previous assessment. And to support that, you listed the following assertions. The first was a lack of warming since 1998 and growing discrepancies between observations and climate model projections. The second was sea level rise from 1920 to 1950 being of the same magnitude as 1993 to 2012. And the third was increasing Antarctic sea ice. Do you recall that?
yes.
Okay, let's look at those assertions and see how they've aged. And let's start with the alleged lack of warming since 1998. Let me propose first that 1998 was an exceptionally strong El Nino year, so picking it as a start or end date for a period builds in an anomaly. Is that correct?
Yes. Do you want me to explain my perspective on the
I'll
recent?
give you time at the end, but I'd like to get through my questions to you first, if I may. So is it true that the last years, 2015 to 2022, have been the 8 warmest years on record? Is that true?
Yes.
That is
Yes.
true. So is it still your testimony that there actually is a lack of warming?
There is, if you read the fine print in my 2014 testimony, my main point was that there was a great deal of natural internal variability that influences decadal scale variability.
It was you who used the phrase lack of warming, and I'm asking if you would still describe what's going on as a lack of warming.
No, we've seen a big super mega El Nino in 2016, which remains the high point. And since 2016, we haven't seen any
lack of warming
further increases beyond 2016.
So let's go to your next point about modeling discrepancies, that there were growing discrepancies between observations and climate model predictions. I'd like to show you a review that was done of models that were run by the IPCC back in 2004. And for those of you who are not familiar with the graph, the blue part defines the range of the different models that were run for the IPCC. And the black line that runs through the middle of that range is the mean of those models. And the red goes back and is actually observed temperature information. So the first two, the blue and the black, are the prediction range and the prediction mean, and the red is what actually happened. And it strikes me that it looks like it's tracked pretty well. So let me ask you, Dr. Curry, is it still your testimony that climate modeling has not proven accurate?
Okay, this is the diagram you're showing is a flawed analysis. Let's pay attention to what the most recent IPCC assessment report has to say. They found a number of global climate models running too hot. In fact, they even changed their way of making projections for the 21st century that relies less on climate models. They no
Dr.
longer
Curry,
use the global
doesn't the
climate
blue
models.
range imply that there were some models that ran too hot, but also others that ran too cold, and that's why there's a range?
Yeah, on average,
Got
on
it. Thank you.
average.
And then the average is the mean, which is the black line, which tracks extremely well with the
That
red
particular
data,
graph
correct?
that you have is a flawed analysis.
Okay. Well,
Let's
let me
pay
go on.
attention
You
to
disagree
what
with the
the
analysis, I get it.
IPCC's text assessment report
You
has to
talk
say.
also that there's been no increase in sea level rise rate. According to the IPCC, sea level rise has more than doubled from the 1901 to 1990 period to the 1993 to 2015 period, and that since 2015, it has accelerated further beyond the doubling. Do you dispute those determinations?
The point I made in my 2014 testimony is that there is a great deal of multi-decadal variability in sea level rise, which we saw a sharp increase in the first half of the 20th century. I'm not saying that sea level rise isn't increasing. I'm
Okay.
not saying that
Are you
global
saying that this
warming
rate of sea level rise is not increasing? Or do you concede that both sea level rise is increasing and the rate of sea level rise is also increasing?
It depends on the time scale you look at and the causes that you attribute to it. It's, yes, yes, there has been.
The history of the Industrial Revolution, the period in which emissions have begun to have an effect.
Okay.
I'm not talking about paleo history.
Okay, sea level rise, the modern sea level rise started increasing in about the mid-19th century. This is coming out of the Little Ice Age, and at that point had little to do with fossil fueled warming. So
Is that
there
still
are
the
a
case
lot of
today, or does it now have to do with fossil fuel warming?
Fossil fuel warming is certainly contributing to the slow creep of sea level rise. I've never questioned that.
Okay, and you say it's a slow creep, but it's also an accelerating upward rise, is it not?
The how to infer acceleration in sea level rise is disputed among experts.
Okay. You've
It's a
accused
very
the
slow
IP,
acceleration.
you've accused the IPCC of corruption. Do you stand by that term?
The IPCC is a highly politicized organization. The recent synthesis and assessment report for the sixth assessment that was just released this week, I mean, that is a very highly politicized.
Do you stand by your use of the term corruption regarding the IPCC?
It has to be qualified. It's a highly politicized organization.
How about the IPCC's definition of anthropogenic climate change being a hoax? Do you stand by that term?
I've never used those words.
Okay. Let me take you into the I'm actually reading off a blog with these definitions in mind. Here are two examples that qualify as hoaxes that I've previously written about. The UNFCCC definition of climate change arguably qualifies as a hoax. So I refer you to that, and with unanimous consent, we'll make that a part of the record. If we don't mind, let's go to Exxon.
Would you like me to clarify that statement?
I think it needs a lot of clarification indeed. And I'll let you clarify it for the record. Okay?
Okay.
You'll have all the time in the world to write whatever you want and add that as a in a response to the record. So let's look for a moment at other models if the IPCC is potentially corrupt and if its definition is a hoax. Exxon.
The IPCC, can I clarify before we go much further? The UN Framework Convention on Climate Change now defines climate change to be only human-caused climate change. their definition does not include natural climate variability. And this flies in the face of all the understanding of geology and atmospheric science and all the other scientific fields. It's a political definition that the
Fair enough.
UNFCCC
And if you want to
has
expand on that,
provided.
you're welcome to do so in your response for the record. But let me take my time here and show you the graph that Exxon scientists developed to model climate change, both CO2 concentration and observed temperature change. And for those of you not familiar with the graph, the original black lines are the ones that are developed by the Exxon scientists. The blue line is the actual measurements, and the red line is the actual measurements, the blue being CO2 concentration and the red being observed temperature. Do you concede that Exxon's models prove to be pretty accurate, just like the IPCC models?
No, that model is a toy model that Exxon used. And I don't think it's a useful contribution to the dialogue.
In 1968, the American Petroleum Institute commissioned a report on climate change from scientists at Stanford. And those scientists concluded, I'll read from the report language here, significant temperature changes are almost certain to occur by the year 2000, and these could bring about climate change. If the Earth's temperature increases significantly, a number of events might be expected to occur, including the melting of the Antarctic ice cap, a rise in sea levels, warming of the oceans. It is clear that we are unsure as to what our long-lived pollutants are doing to our environment. However, there seems to be no doubt that the potential damage to our environment could be severe. Do you doubt the scientists hired by the American Petroleum Institute or their statement?
Our knowledge of climate change was in its infancy in the 1960s. The first assessment report by the IPCC, published in 1990 or 1991, found that there was no evidence of human-caused warming beyond natural climate variability at the time of the early 1990s. And that
so
was...
the API scientists got it wrong, too, when they presented that conclusion.
No, they had a weakly justified argument and a weak knowledge base at the time.
And events have proven them wrong in some fashion, do you believe?
That's useful. So it's not something that's useful
Okay.
to consider at this point.
So the other thing you cited was increasing Antarctic sea ice. And the last 8 years have seen below average summer minimum ice for the Antarctic, with this year being a record low. Do you still stand by the proposition that Antarctic sea ice is increasing?
There's a great deal of interannual and decadal scale variability. The IPCC does not make any assessment that human-caused warming is contributing with confidence to a change in the Antarctic sea ice beyond natural climate variability.
But you think that the Antarctic sea ice was increasing, just as a measurement. Is that still correct?
There's, like I said, there's a great deal of year-to-year and decadal variability in the Antarctic sea ice, which was what I was commenting on.
Okay. Let me refer you back to an article that you wrote in the Washington Post in 2007, and I'll read your words then. If the risk is great, then it may be worth acting against, even if its probability is small. Think of risk as the product of consequences and likelihood, what can happen and the odds of it happening. A 10-degree rise in global temperatures by 2100 is not likely. The panel gives it a 3% probability. Such low probability, high impact risks are routinely factored into analysis and management strategy. And I'll interrupt your quote to say probably by the kind of folks who are here sitting in the room with me today, the experts and the executives of major risk-bearing enterprises. Whether on Wall Street or at the Pentagon, you continue. The rationale for reducing emissions of carbon dioxide is to reduce the risk of the possibility of catastrophic outcomes. Making the transition to cleaner fuels has the added benefit of reducing the impact on public health and ecosystems and improving energy security, providing benefits even if the risk is eventually reduced. I've yet to see any option that is worse than ignoring the risk of global warming and doing nothing. Has your view changed since that 2007 article?
My notions of risk were naive circa 2007. In the intervening time, I have educated myself very substantially in risk sciences, and I have a book in press entitled Climate Uncertainty and Risks that has been extensively reviewed, peer-reviewed by an academic press. And that book outlines my current understanding of how we should think about climate risk. Some of my understanding I was able to include in my written testimony submitted to this committee.
In 2014, I asked you if you thought there was real risk from climate change and should we figure out how to deal with it, and you replied, we may decide to do nothing and see what happens. Do you still recommend that strategy?
I didn't recommend that strategy. I said that is an option.
Do you still consider it to be a realistic or plausible or prudent option?
I think we should actively work to adapt to extreme weather events and sea level rise. I think we need new energy infrastructure for the 21st century with more abundant, cleaner, more reliable energy.
And in your testimony here today, you suggest that one of the things that can save us from climate change and reduce the risk is volcano eruptions. Is that correct?
No, I'm saying that climate models do not include the simulations for the 21st century do not include scenarios of extreme explosive volcanic eruptions, such as occurred in the early 19th century. If those were to occur, we could see a 0.5 degree centigrade cooling over several decades. The point of that is to emphasize that natural climate variability can be very substantial, and this isn't properly taking into account in our considerations of how the climate might play out in the 21st century. That's the point that I'm making.
Let me close out with a question for the witnesses who are here in the room, and that is to offer your view on the diligence, integrity, and reliability of the modeling that you count on in doing your planning and projections. Starting, I guess, with Mr. Anderson, we'll go across the four of you and conclude the hearing.
That's a great question. I would say one of the special things about the models that the insurance industry uses is that it actually, money changes hands over the interpretation of those models. So the confidence around them and the need for those models to be as up to date and insightful is critical to
Powerful incentive to get it right.
So I think it's as I think Mr. Teodoro said, it is something that we are continuing to work on as new information becomes available because it moves markets. And so it's critical that we continue to improve it.
Ms. Watkins?
The risks that we're modeling are complicated, and so the models need to be complicated to be useful. They don't agree. They do evolve. The question is, can they be used safely and appropriately? And that does require expertise. I think that upping the level of expertise in terms of risk-aware, climate-aware planning is going to help an awful lot in demystifying these models.
But you count on the models, and they're valuable to use in doing the planning and the work that you do.
They're definitely the state of the art for actuaries in getting the risk accurately priced and evaluated, and that's what we do.
And one of the reasons that this is a difficult enterprise is because things are in fact changing. Is that not the problem?
That's right.
Yeah.
But we are trying to use the models to evaluate what the changes are and what that means for the potential outcomes.
Dr. Keyes?
Thank you for the question, Senator. The data that we use as researchers often comes from the government, and we're especially thankful for the scientists at NOAA and elsewhere who make their data available and make regular improvements to their data. So they're doing outstanding work. I think there is room for improvement in terms of sharing data between the private sector and the public sector and understanding what the differences or discrepancies might be between the different models. I think there's also a role for the democratization of this data to make it more accessible to households so that they can better understand the risks they face. I think one of the asymmetries is that the insurance markets often know a lot more about the risks than the households or the businesses do.
Mr. Theodorou, reliability of models?
Thank you, Chairman Whitehouse, for the question. The modeling industry has really advanced by leaps and bounds since it was essentially born in 1992 in the wake of Hurricane Andrew. And since that time, there have been three main models that are used and licensed by risk practitioners. Typically, large insurers and reinsurers use all three, and they may have their own proprietary. There's a fourth model, which has now entered the fray.
And Mr. Anderson is correct that a lot of money rides on getting it right, in addition to potential fiduciary liability if you really blow it, correct?
Yeah, licensing the models is not an inexpensive proposition. So as I said earlier, they're not capable of getting a point estimate exactly how much loss we're going to have at this particular time, but directionally is what we look at to give the headlights into where we're going.
Love hearing you use the word headlights. That's my phrase. I say science is the headlights that drives us forward and lets us see what's coming. And with that, let me call the hearing to an end. I thank you all for your testimony. I want to state that questions for the record from colleagues are due by noon tomorrow. And we ask the witnesses to respond to any questions that they may receive within 7 days of receipt. And in addition to responding to any questions received, I offer Professor Curry the opportunity to elaborate on her answers to my question in any way that she sees fit, so she feels she's had a full and fair chance to respond. And with that, the hearing is concluded. Thank you.